Well, let's welcome in our first guest on the program, Post-Market Open. Mihir Vora is Chief Investment Officer at Trust Mutual Fund. Mihir is with us in our studios. Mihir, good morning. Good to have you with us here. And good to see you in your new avatar, I should say. Long journey at your previous organization, and good to see you once again. But we are also meeting in the midst of a bit of a correction, Mihir.
Yes.
Is this likely to continue for a bit longer, you think, or how have you looked at markets recently?
It is a good correction, I would say. Let's look at the positives first. Negative, of course, is the market's down. Positive is that it's mostly because of global factors. I think the higher for longer situation as far as interest rates in the US are concerned is leading to a asset class correction across bonds, across equities, and that's kind of trickling down into emerging markets, including India, even though our standalone fundamentals are relatively much better than the rest of the world. So it's mostly because of global factors. Add to it a bit of the uncertainty as far as the Israel situation is concerned and the Ukraine situation is concerned. It means that probably the supply chain disruptions and inflation can remain higher for longer. And the fact that the US fiscal deficit has also been out of control means that bond markets globally are in a real state of panic. Because there's going to be huge supply of US bonds, and you look at the long bond yields in the US, 10-year bonds, 30-year bonds, they are at 5% plus, which is frankly speaking not sustainable for them. So here the markets are basically a step ahead of the Fed, whereas the Fed wants to kind of stop loosening, but the markets are saying that you're going to have to issue so many bonds because your yields have gone up and refinancing of your maturities are coming up in the next couple of years, that you will not be able to reduce rates, which means that we might see a US slowdown or a sharp slowdown or even a recession sooner than expected. That's the concern.
You may not be able to hike rates further.
You may not be able to cut rates because they were saying the expectation was that next year, second half of next year, they might actually start easing out, but that's not going to happen.
Okay. Mihir, good morning. By the way, congratulations on your new role. And you did what, 9 years at Max Life before moving on. It's a long journey, and hopefully you'll have an equally successful one at Trust.
Thank you.
So congratulations. But for the market as a whole, I mean, this is a situation that we've seen deteriorate very rapidly. Just in the last 10-15 days, the market has moved from sort of a buy on dips to a sell on rally. But we also have a geopolitical crisis, something that we haven't seen in the recent past, right? So it is kind of creating a lot of caution in the system. From a retail investor standpoint in India, what do you do now? Do you raise your cash levels, or do you continue to just keep your investments running?
I think the SIPs or the regular investment plans should not be discontinued for sure, because it's precisely because of such volatility that SIPs are there, because you'll buy something lower, you'll buy something higher. But in the long term, it works out. So the systematic plans, definitely, whether it's your insurance premium on a yearly basis or your SIP on a monthly basis, you should not definitely discontinue. Volatility is a nature of the beast. Like a 4-5% correction is something that we see 2-3 times a year in any case in the equity markets. So this kind of correction is not really something to worry about. I would be worried if we are worried about the long-term growth prospects of India, which is not the situation as of now.
Hi, Mir. Congratulations. Looking forward to coming across to your office, and maybe having a chat with you. But you mentioned at the start of this conversation that most of the fall is global in nature. Do you think it's, the mid-caps in particular, they ran ahead of themselves? And with regard to approaching to the Indian markets right now, most of your money would be drifting towards large caps rather than the mid and small caps, because there were signs of some frothiness out there.
Certainly. If you'd also, I think you've been following my tweets also. I've been mentioning this, that large caps, even at say 19,800 or 19,900, the Nifty was not that overvalued, in the historical perspective, given that we still expect 15+% of growth, earnings growth. So that's a healthy valuation, I would say, for the Nifty. But there was some froth built up in the small cap, micro cap, the SME index, the SME stocks, which probably naturally would correct faster because they went up faster.
Yes. I like that tweet, talking about tweets in the bull markets. What? The investors have the money, the promoters have the wisdom. But when it turns around, then the promoters have the money.
And the investors are left with the wisdom.
That was a good one.
Okay, so how are you feeling about individual sectors now? Because, this earnings season so far has been very patchy, to be honest.
Yes.
Some good, some really bad. And, some key pockets like IT have been struggling quite a bit. What has your reading been so far?
Exactly what you said. IT has been well, the results have not been so bad. but the guidance has been quite weak. So the visibility is reducing as far as IT is concerned. And as we discussed, it's natural because we are talking about less visibility as far as US and global growth is concerned. So IT would naturally be impacted in the next few quarters because of that. In the local economy, I think the capex cycle still continues, whether it's private sector capex or defense spending, railway. So that theme continues. We can talk about valuation separately, but the growth in these segments is likely to continue, especially the government-linked growth. And in an election year, frankly, I don't think the government is going to let down as far as spending on growth is concerned for the next few quarters. I would also expect some kind of populist measures. So I don't think the rural economy has picked up that well yet. The economy recovery is still a bit K-shaped in nature. So I think the government's thrust towards subsidies in the rural segment should also continue, which means that sectors like FMCG, which have not yet done so well, may start to see some action, though the results have not been that great.
Well, that capex point, the last data point indicates that new project announcements are down sharply. I mean, I'm talking about the second quarter data. I think this is CMI collects the data. They're down very, very sharply, and I think the bank credit growth also shows that lending to industry has actually fallen. I mean, in line with that data point. I mean,
yes.
Any thoughts on that?
See, as far as lending is concerned, the big corporates are not borrowing because they have enough cash flows to fund their own capex. It's the mid-sized corporates, and if you look at the order book of the capital company, they are not reflecting this kind of a slowdown, which means that a lot of the action and a lot of capex is happening in, say, 50 crore, 100 crore kind of mid-sized companies, and my guess is that a lot of it is because of manufacturing exports across the segments. We can talk about them later. But I don't see a sharp slowdown in capex spending by the private sector. I think it's just picking up, I would say.
It's picking up.
Yeah.
And any straight-off beneficiaries of that, and as you see it, which is you'd want to buy sort of companies which get these orders, right? I mean,
Yes.
from the private sector side. So,
Absolutely.
I mean, top of the mind ideas.
So there are multiple sectors. For example, in the power sector, you got metering companies, you got transformer companies, and a whole chain of companies in the T&D sector. And I think given the way the grid is evolving, we need more and more investment.
I think we can talk
distribution
stocks now,
infrastructure.
maybe.
Yeah, exactly.
Earlier we could not talk stocks.
No, I mean, can't yet.
Please give us some ideas.
I'll have to check with my compliance.
Can't yet.
Yeah, a couple of names, notably some of those large names. We talk about the Nifty being at 20,000. Many of them didn't participate. Let's focus on the large cap names.
That is 1 minute. He was giving us names.
Yeah, that's right. I'm
Not yet.
getting to that.
Smart metering companies, you were saying.
Yeah.
Mihir.
How much
So,
of, yeah.
what do you like there? I mean,
I still can't give
not
names.
that many names there.
Yes.
But what else, really?
So power sector, T&D will require a lot of investments. In fact, renewables is another big space opening up. I mean, we can go on and on, defense, railways, all those things that we have talked about so often. I don't think that's going to change in the next few quarters. That's going to continue for a while.
But
real estate is picking up.
These
after a long
stocks as
time.
well have already reacted. Now, if you look at the smart meter plays, if you look at renewables as well, you still believe they still have a bigger runway? Because some of them are up, 3, 4, 5 times?
Yes, but look at the last few days. If the correction continues the way it is, you'll see old prices sooner rather than later, which means you should always keep in mind the medium-term fundamentals and wait for your price.
In terms of other pockets, right, there are so many pockets that have done well, whether it's defense, whether it's auto ancillaries, for example, and we're going to speak to one of them now in a bit, whether it is the consumer durable companies. Any of these pockets where if the correction deepens, you would sort of get into it, even real estate for that matter, ceramic companies.
Certainly, ceramics is one area where not only are we doing well on the local front, but even exports are picking up. In fact, I read some reports where we might be one of the largest exporters of ceramics to the world. So that's definitely a pocket. So as I was saying, this manufacturing theme across segments is here to stay. It's not going to reverse in a hurry. Even if the global economy slows down, you may see a quarter or two of slowdown, but the China Plus One, outsourcing from India, and Make in India, Atmanirbharta focus is for real.
But this capital goods theme is something that's come back after a very long time, right? The L&Ts of the world, BHEL as well.
Yes.
But these are companies that have, so people have burnt their fingers in them. I mean, especially names like BHEL. But do you think in this correction that we're witnessing right now, it makes sense to buy some of these names despite the rally that we've seen?
See, certainly, for example, the government now realizes that relying completely on renewables for the next 10 years may not be a wise thing to do. You need conventional energy, conventional power production also, and where we have natural advantages. So even thermal power we should not write off, and the stocks have been written off for so long that there is some value emerging there. So, and you talked about the capex theme coming back after a long time. The difference this time is that the capex revival is not in mega projects. It's in thousands or hundreds of small companies investing in various kind of manufacturing, which is what makes me confident that this is more sustainable than before.
Okay, all right. Let's talk about the headline index, Mihir, since you're not giving us any stocks, but we're still hopeful that in the next few minutes you do give us some. We have seen a 5% correction from the top. How much deeper can we go? As we speak, we're at the low point of the day. Those bounces are getting sold into. But on the headline index, if earnings are going to continue, if the capex theme is going to continue, the domestic-facing sectors are going to do well, how deep can the correction be on the headline index?
My guess is not more than 5 to 10% maximum from these levels, because we are already with the 5% correction and the fact that we've already passed 6 months of the financial year, we are back to long-term average levels of valuations as far as price to earnings is concerned.
Okay.
And earnings growth is likely to be about 15%, which is again kind of little more than the long-term average. So valuations at long-term average, earnings growth at a little above average. We are kind of in a relatively safer zone compared to say 6 months ago.
So another 5% correction is doable, but not beyond that is what you think so?
Okay. Your thoughts on banks? Because we've had, compared to at least the rest of the universe, banks have done quite well this time, whether it's ICICI Bank, whether it's something like an Axis Bank as well. Would you, even HDFC Bank for that matter, despite the merger, right? Would you raise your allocation to private sector banks now?
Certainly, because they are really starting off with a clean slate. The balance sheet issues are past us. Retail lending is something that they're focusing on, which has better margins. And, the fact that banks still have the wherewithal to drive economic growth, and we haven't even seen the beginning of corporate credit growth pick up. So once corporate credit picks up, I think banks will accelerate even faster, even though we have seen credit growth, but I think credit growth can accelerate further.
Okay, all right. We'll leave it at that. Mihir, thanks a lot for joining.
Check with your compliance and we'll talk stocks, right?
He won't come back here next time.
We'll get him here.
All right, thanks a lot.
Thank you so much.
Thanks
Thank
for
you.
joining in. Okay.